how to use your superannuation to buy an investment property. Have you ever wondered how you could make your superannuation grow faster than it is currently? We've come to the right place. It's Marissa here and
Bryan from Rise High.
Yes, we're from Rise High, and today we're talking about all things self-managed super fund and how to actually build your property portfolio and use your superannuation to build your property portfolio and make your superannuation go further.
Yeah, exciting times. So yes, a very, very popular strategy that a lot of investors use, especially once they've capped out in terms of their borrowing capacity. So Marissa, do you want to kind of start off in terms of what is a self-managed super fund?
Absolutely. So a self-managed super fund is essentially an ownership structure. So if you're an employee in Australia or if you're running your own business, you're likely to have some form of superannuation in Australia already. And that is, it could be a retail fund, it could be an industry fund, or you can have a self-managed super fund, which effectively means that instead of putting your superannuation into another fund that's a commercial fund that's running, you actually put your superannuation into a trust fund that you actually manage yourself and you have full control over. And obviously there's pros and cons to doing it both ways, and we we'll delve into that in more detail in our upcoming free seminar on self-managed super funds on the 28th of July. I think we've got a couple of spots left for that. But effectively, being able to control your assets, being able to control your superannuation gives you a lot more freedom and flexibility than what you would have if you had your superannuation in a retail or industry fund. And specifically, the benefit that it does give you is the ability to leverage. So it's the only way that you can actually borrow money to make your superannuation go further. So for example, if you had $250,000 in super, if you were investing that in a retail industry fund, that $250,000 would be growing annually at the rate of return that the super fund is receiving based on the $250,000 base. If, on the other hand, in your self-managed super fund, you use that $250,000 to buy a $600,000 investment property, then the rate of return that you're actually achieving is on a base of $600,000 instead of $250,000. So what it does is it enables you to make your superannuation grow faster by using the bank's money to help your accumulation of wealth in the future.
Yeah, and buying in a self-managed super fund is a really, really good way of you scaling your portfolio as well. Yeah. Borrowing within a self-managed super fund is completely independent to your personal borrowing. So as an investor, if you're looking to scale your property portfolio, considering buying within a self-managed super fund is, I think, something that you should not just look past. It's definitely a really, really good way of building your wealth, and it's a very good tax structure that's really, really good as well. Again, we'll dive into this in our seminar, so come along on this seminar, and we'll definitely go a little bit more in depth in terms of the pros, the cons, the tax benefits of a self-managed super fund, and whether it's a suitable vehicle for you.
Yeah, absolutely. So if you want to learn more about it, come along to our free seminar. We'll have the link in the comments below. The seminar's on the 28th of July. I'm pretty sure we fully subscribed for the seminar, and we've just released a few more tickets just to make sure that the people that really want to get in there don't miss out. We'll explore everything in detail. But today what we've got is we do have a few questions that have come through in advance of today's Facebook Live. So we will answer those for you live, just so we can give you a little bit more information about it. But definitely would love to see you at the seminar on the 28th of July. So let's get stuck into the questions, Bryan. We've got a nice little hat here full of questions.
Yes, awesome. So the first question is, can I use equity within my self-managed super fund investment property? Do you want to take that answer?
Sure. So when you buy a property in a self-managed super fund, it's called a limited recourse loan. What that means is that the loan is only secured by the investment property that you're purchasing in the super fund. There are very strict rules and regulations around what can and can't be done with a self-managed super fund. So when you have property normally in your own name or in a trust, you can actually use the equity growth in that property to borrow against it in the future to buy more properties. When you own property in a super fund, you are limited to what you borrow initially. So what that means is when you initially buy the property, you will get a loan for that property, but you can never again draw on the equity growth in that property to buy more property in the future. And that's the government's way of trying to protect you from over leveraging in your super fund. So whilst you can use the equity initially to buy the property, you can't actually use the equity growth to borrow against. But what you can do in the future, if you ever want to sell the property, like Bryan mentioned before, there's some very good tax incentives. So when you get into that retirement phase of your life, you can sell the property tax-free, because your tax rate goes down to 0%. So there are lots of other ways that you can access that equity without borrowing against it.
Yep. Cool. Question number 2. So what if I'm self-employed and don't contribute to super? Can I purchase a self-managed super fund investment property?
Good question. You've had a scenario like this recently, haven't you, Bryan?
Yeah, and I guess that's where working with an investment-savvy mortgage broker, one that really understands self-managed super fund lending, is going to be really, really important. So that scenario that I recently assisted my clients with, they are self-employed, and as a self-employed client, you have the option of contributing to super or not, unlike if you're a PAYG or salaried employee, where you get the super guarantee from your employer. So in instances like this, there are ways and there are lenders that can potentially consider like a low-doc self-managed super fund lending type of structure based on your surplus cash flow within your current profits within the business. So there are definitely options. So if you're a self-employed client and you haven't been contributing towards super, definitely there are options available for you, and you just have to speak to the right mortgage broker.
Yep, awesome. Let's see the next question. What type of properties should you invest in super? Okay, excellent. So when you do invest in property in a self-managed super fund, you're best to find set and forget properties. So properties that are already established, that are set and forget, that you can just put a tenant in them and they're great to go. So I like to look for properties that are already established properties, so not brand new. And the reason why we don't go for brand new is because the benefit of brand new is that you get your depreciation benefits, which is a tax deduction. But because the tax rate within super fund is so low, you miss out on some of that benefit. So I think just pretty plain and simple, established properties with a good rental yield that you can put a tenant in, and that's kind of the property that I would look for in a self-managed super fund. What do you think, Bryan?
Yeah, I think like a mixture of both, like good capital growth, good yield kind of type of properties. You don't want to be aiming for something that's too low of a yield, because then that will put strain against your self-managed super fund, and you potentially have to start contributing within super, which then makes your cash flow outside of super a little bit tighter. So
It's
very
something
important.
that will look after itself.
Correct. And something that doesn't really need too much of care as well, because it's really, really hard to make improvements against. Well, we can't make improvements against a self-managed super fund investment property. So something that's basically like what Marissa mentioned, set and forget.
Yep, excellent. Let's have a look at the next one. Can I renovate or develop a property held in my self-managed super fund? Well, this kind of is a good flow-on question from the question we just had.
Yeah.
And the short answer is no, you cannot. So there are, like we said, there are limitations when it comes to self-managed super fund property. You can't make substantial differences or changes to your property. So renovating or developing is very difficult for a property in your self-managed super fund. So you're better off buying a set and forget property that doesn't need to be developed or doesn't need to have an extension put on it, because you're not allowed to do things like that with your self-managed super fund property. You can improve what's already there, but you need to keep the structure of the property substantially the same.
Yeah, and I guess when you're borrowing within a self-managed super fund, whether it's for investment property or some other types of assets as an investment, it's mainly important thing to note is that when you're using a self-managed super fund, it's solely for the retirement purpose. So you have to protect your retirement as well. Don't take unnecessary risks if you don't have to.
Yep, great.
Awesome. Next question would be, how does self-managed super fund property investing fit into a long-term wealth strategy?
Yeah, great question. I think it's just part of, like the question says, it's part of a long-term wealth creation strategy.
Yep.
So I think it's definitely not the only thing that somebody should consider. But like you said before, Brian, I think it's just one piece of the puzzle and just one of the strategies that investors can consider to accelerate their wealth creation for the future and accelerate that passive income that they can get when they reach that retirement phase of their life. At our seminar on the 28th of July, we will have a financial planner and an accountant along at the seminar as well. So all of your questions in regards to setting a great long-term financial plan will be covered, and it's a really good strategy to consider.
Awesome. Well, last question. How much super do you need to get started with a self-managed super fund property purchase? I can take that one.
Go for it.
Well, as property prices are increasing, generally what you would need for a self-managed super fund purchase would be a 20% deposit bare minimum. It's very hard for you to go into lender's mortgage insurance territory with a self-managed super fund. You also need to cover your stamp duty, your purchase cost, setting up a self-managed super fund as well. And some lenders have what is called a liquidity rule as well. So the liquidity that's left behind after you purchase an investment property. I think where right now we're seeing in terms of where property prices are, the sort of balance you need within your super fund before you get started would be around the 250 kind of mark. That gives you enough liquidity left behind, that gives you enough for you to purchase a decent investment grade investment property. So that's generally where the balance needs to sit. But again, it comes down to your personal circumstances. Very important that you speak to the right professionals before you even dismiss the idea or feel like you have too little to start. Again, doesn't hurt to ask the question anytime.
Yeah. So that brings us to the end of our Facebook Live today, what we have time for, but we hope to see you at our seminar on the 28th of July, and we hope to be able to help you with your investment journey. Thanks for tuning in today. We will see you again soon. Thanks. Bye.